So let's get going as we're almost upon November. I don't know if some of you folks know about this, but there's an election coming up. So first to hear from me, then there you go. No. So where are we? Year to date. Let's start there and then what we see going forward. Year to date, utilities continue to be the best performer last few months as well. Behind that are communications, which are a lot of tech stocks, financials, and technologies year to date. In that top 4 or 5. Recently, real estate's been coming up as well as discretionaries, think luxury items and as such there. Growth continues to outperform value pretty easily. And we're starting to see a heavy outflow, in fact, out of energy and healthcare companies really over the last month into technologies. Earnings season for technologies coming up next week. So we shall see. As the time you watch this, they'll be coming out next week. Financials, of course, hit it out of the park and looked very good, getting earnings season off to a good start. 37% of companies have reported, with 75% beating. From a technical standpoint, the market has held up pretty nicely with just under 83% of stocks above their 50-day moving average and just under 80% above their 200-day moving average, although there is some slowdown on some of the indicators that I'm not going to go that deep because I know you probably don't care about the granularity, but there is a little bit of a slowing and a waning there in momentum. But who can really blame the bulls? I mean, September and October, the market's generally red going into an election, and it has been resilient. 2 weeks into an election can be challenging as well. That's where we are. So we shall see if we start to grind some of the gears. And then post-election, generally you do see a drift to the upside with mostly cyclical stocks, which have been doing pretty well, picking the mantle from some of the higher beta companies. Again, momentum and growth have been outperforming, as I said, year to date. So where do we see things? Well, from a fixed income standpoint, for the year, of course, lower duration, right, shorter time frame, especially on the treasuries, have outperformed. High quality debt on the corporate side has outperformed. Senior bank loans, preferred stocks have done well. And in your conservative strategies like active capital preservation, you'll see all of those. So that's done pretty well as well. Another asset class has done extremely well is gold and your silvers, gold miners, and you'll see for a while that we've been in that asset class. Now, one of the things I was going to mention as we start to look at exposure to markets, hedge funds notoriously bearish, only about 50% exposure to U.S. stocks. That may be actually foreshadowing more upside. Never know if it's a direct correlation there. Non-hedge funds, though, just National Association of Active Managers that tactically run money, unlike most advisors out there, but most active managers in general, they are still in the high 70s, down from 90 early in the month. We somewhere are in between there as we've been opportunistically, bullish over the last couple of months, just taking advantage of the trend, regardless of the seasonal conditions that generally you see. Now, speaking of seasonal, we're about to enter the 6-month period of time of seasonal strength, right, from November into May. However, that's not always the case depending on macro headwinds. Now, speaking of the macro, as we look at bond yields, the 10-year yield is actually gotten back to where it was before the Fed lowered rates. 2-year has not, but the 10-year has. Still well below where it was early in the year, but above or right in that area before the Fed started to soften. And what we're seeing also is the ECB, right, European Central Bank, for the first time in over a decade, I think, lowered rates consecutively, first time in a decade. So that has created strength to your everyone's favorite, the greenback, the dollar, right, which is just boat racing all the currencies over the last few weeks, up, I think, 5% versus the basket. Generally, that creates a little bit of a headwind, right? And we've seen, again, some turning of the gears in the market, as we obviously have seen certainly some red on the screen here over the last couple of weeks from that standpoint, and pre-election, not a surprise. Dollar getting off the mat creates a little bit of a challenge. So where does that lead us? So many different moving directions that it is basically like a lazy Susan spinning. Now, we can be anything but lazy. So we will stay eternally vigilant in monitoring that. You just stay frosty. If you have any questions, of course, about your own risk tolerance and how that applies your money's being managed regardless of the models based upon the macro picture, certainly let us know. House cleaning note, they made me do it. No, I'm just kidding. Required minimum distributions. Again, if you have any questions on the timing of those, talk to your personal wealth advisor. My clients, you already know that we proactively reach out, tiptoeing well before the bird is in the oven on Thanksgiving to look at logistics there. Again, many different factors that I just mentioned. We shall see going forward what happens. We will have our foot looking for that brake pedal if we need it, but not taking it off the gas if that is where the road is leading us. Till next time, always a pleasure. We never forget we serve you. Jonathan Camarda. I was going to tie this up, but not wearing one. Till next time.